if a company is using standard costing, at the end of the accounting period, they're going to have balances in these variance accounts for the various reasons we've talked about in class relative to labor and material, and they don't just leave them in these accounts as an item um, on the income statement sitting in their own right? So they go somewhere, in other words, and the accounting for them is very easy. If we look at like a direct material price variance, you can think of them as maybe an expense account. If it has a debit balance, that means that's going to reduce the profit for the current accounting period, so it has a negative impact on profit. And if we have a favorable variance, it'd have a credit balance, so it would increase profit. But at the end of the period, we zero them out. So we look at the balance in the accounts and we simply close them out. We would credit direct material price variance, and you'd have to debit something else. And that's good and nice to know how to work the journal entry, but more importantly, and this is where I think the author does a poor job in our text of explaining, like, well, how did it even get into this account in the first place? And so I'm just going to give you a quick little review of how that happens. And so it really depends on whether it's a materials price variance, materials efficiency variance, a direct labor rate variance, or direct labor efficiency variance. The concept still holds true for all the variances. I'll just show you the materials price variance and how that might work. And so what a company does is they set the standard at the beginning of the year, and we don't know what this company is manufacturing. Could be steel products or something like that. And let's say they're going to work on a batch of product, and the standard cost have established say that you're only going to need to purchase $54,400 of material. So when we go out and we talk to our purchasing department, they buy enough steel to make our product. They say, that's great, you put that standard together, but you have no idea what's happening in the steel market, and prices are through the roof. So they say, well, we've got to buy the steel, and the same amount of steel to produce the job that you thought it was going to produce now runs 100,000, not 54,400. So we would logically put into our direct materials account $100,000, because what we would do then is if we paid the creditor on account, we would credit accounts payable for the amount we owe them. So we would have a credit balance in accounts payable. I don't have a T account here for 100 grand, and that account would end, and the entry would balance. And that'd be logical, but that's not actually what happens, because in using standard costing, we put into the direct material account the amount we've allowed or planned for using, which is $54,400. But we're going to pay the vendor 100 grand. So if you made this entry right now, you don't have a balanced entry. And what happens is the difference between the standard cost and the actual cost gets pushed into this material price variance. So you'd have $45,600 sitting in this materials price variance. And it's easy for us to understand that that's an unfavorable variance because we spent 100 grand. Our standard setters said you should only spend 54,400 because the price of steel is up so much. We say, well, that's a pricing variance, and so we shouldn't blame the production department if we have an unfavorable variance, because they had nothing to do with the purchase of the steel. So that's how the amount gets into the materials price variance. And what happens then through a costing system we've learned, and we talked about job order costing, is as that company then takes the steel out of the material and actually produces it, they would credit the direct materials for whatever the standard cost is. Say this is one batch of product that's going through the plant. They pull all the quantity out of direct material, and then they put it into work in process. So it sits in work in process until it's completed, and the related material cost then, once it's completed, moves out of work in process and into finished goods. So the same flow happens, right? We go from direct materials to work in process to finished goods, which shows up on the income statement. But logically, you can see this. So once this is sold, we would credit finished goods, and we would debit cost of goods sold, which I don't have on here. But cost of goods sold would be understated, because cost of goods sold is at some fictitious standard that doesn't know the actual realities of the market in relation to the price of steel. So the finished goods is not correct, nor is the finished goods is at zero now, but the cost of goods sold is way understated because we don't have this unfavorable purchase price variance, materials price variance. calculated in there. So what we do then at the end of the accounting period is we say, well, you know, if this amount is immaterial, this amount, the difference between the standard and the actual, it's the variance. If it's immaterial, we close it right to cost of goods sold. So this account goes to 0, and we debit cost of goods sold. So that really gives you a better detailed picture as to how and why we close this out. So we're saying is this standard is obviously wrong, but we wanted to keep it separate so we could manage our organization accordingly and have a conversation with the purchasing department, and then the standard setters know to not set the standard so low or something like that. So at the end of the period, we're gonna look at what accounts we're gonna deal with. We're gonna debit some accounts, and we're gonna credit some accounts. The accounts that have a debit balance means they had an unfavorable variance throughout the period, and that's regardless of whether it's efficiency or price variance for labor and material. And the offsetting account, if these amounts are determined to be immaterial, go right to cost of goods sold. So we're told that the unadjusted cost of goods sold account is 9. So I could change maybe this heading, cost of goods sold. What they're telling us is the unadjusted amount before we've closed any of the variance accounts is 982,140. And we know that's wrong. We know it's understated for these reasons, and perhaps it's overstated if we put too much in there, which is what happened with the labor efficiency variance. So this account is going to be cost of goods sold. And the amount you're going to debit, you could do each one of these separate, the 45,600, and I'll just do that right now. And we would credit then the direct materials price variance to close it out. I spelt it wrong, but that's okay. And you just go through and do that for every account. You could make one big entry, and so cost of goods sold then would be increased by 45,600, not $45.60. And we just go through and do the same thing over and over for direct materials efficiency. And so I could actually just do this, right? Direct materials efficiency variance. Spelled it wrong. Direct labor rate variance, because that one also has a, so we'd put has a debit balance. We would put a $5,800 credit in here. We would put a $4,350 here. And actually, if we do this in one big compound entry, we are actually going to debit the direct labor efficiency variance for $61,250 to close that one out. Now my cost of goods sold becomes the plug figure. It's the difference between all of these. That's why it's immaterial. It's only $5,500 in total in net debit. So that actually increases cost of goods sold, which decreases profit by $5,500. So very long explanation to show you that this is really the compound entry for the first requirement.